Imagine a family that borrowed money for years. At first it feels manageable, a payment here, a payment there. But then the monthly bills start to pile up. Not just the loan itself, also the interest. One day the family says, "We won't pay in cash anymore, we'll sell something instead." First the gold jewelry, then a piece of land, then maybe the apartment. Now, selling assets can be a rational choice in a crisis. But it also raises the question everyone asks in the kitchen. Why did we borrow this much in the first place? And more importantly, what did we build with it that can repay the borrowing without selling the house? That's the emotional core of the debate we're seeing right now. A public commentator asked in blunt language, "Where did the debt go? What did we actually get for it?" Today we don't treat this as a political fight. We treat it like economists and risk analysts do. We define the terms, we build a model, we stress test it, and we end with practical rules for thinking clearly, especially when numbers look stable on the surface. Because with debt, the most dangerous place to be is confidently wrong. 1. 3 definitions we actually use. Let's define 3 terms in plain language, only what we need. Debt to exports ratio compares external debt to exports. Why exports? Because exports are one of the cleanest sources of foreign currency. Example, if a country's exports are weak, even moderate debt can become heavy. Interest to exports tells you how much interest a country pays relative to export earnings. It's a cost of carry measure. Example, 2 countries can have the same debt, but the one paying higher interest is under more pressure. Residual maturity means how much debt becomes due soon, regardless of how it was originally classified. Example, a long-term loan that matures next year behaves like short-term risk. These 3 terms let us translate emotion into analysis. 2. The real question behind, where did the debt go? When someone asks, where did the debt go, they're usually asking 2 different questions. 1. Allocation. What was the money spent on? 2. Return. Did those projects generate returns, especially foreign currency returns, big enough to carry the debt? You can borrow for roads, rail, power plants, ports, and housing. That can be productive. It can lift capacity. But the debt doesn't care about beauty or ambition. Debt cares about cash flow, and external debt cares about foreign currency cash flow. So the first principle is simple. External debt must eventually be supported by external earning power. Exports are a core piece of that earning power. 3. The anchor numbers and why they don't settle the argument. Let's take the headline figure being discussed. Egypt's external debt around $161 billion. Some people hear that and say, okay, it's down from a higher number before. Maybe things are improving. Others hear it and say, that number is still huge, and it doesn't tell me whether the situation is safe. Both reactions can be understandable, because a single number is not a model. What matters next is, how much becomes due soon? What is the cost of carrying it? And can exports and other FX sources realistically cover the burden? This brings us to our model. 4. Model card. Measure, compare, stress test, correct. Here's the clean thinking model for external debt. Measure. What is the debt stock and what is the maturity profile? Compare. Compare debt and debt costs to foreign currency earning capacity, especially exports. Stress test. Ask what happens if exports dip, interest rates stay high, or refinancing gets tighter. Correct. Policy correction isn't a slogan, it's targeted. Reduce FX outflows, increase FX inflows, and reduce rollover risk. This model turns "where did the money go" into "is the system sustainable under stress?" Now we apply the data triad, 3 lenses. 5. Data triad, stock, flow, refinancing. When you evaluate external debt, you need 3 independent lenses. Lens 1, stock. How big is the mountain? This is the headline. the total external debt stock. But stock alone doesn't tell you whether you can breathe. A big mountain with slow, cheap payments can be survivable. A smaller mountain with fast, expensive payments can still crush you. Lens 2. Flow. How painful is the monthly bill? Here you look at interest and total debt service. This is where the World Bank's framing matters. A country can be in a dangerous position not only because of debt size, but because interest payments relative to exports are unusually high. If interest takes a large bite out of export earnings, the country has less room for imports, essentials, and stability. Lens 3. Refinancing. How much becomes due soon? This is the hidden stressor. Residual maturity matters because markets don't care what you called the debt when you signed it. If a big portion becomes payable soon, the country must roll it over, refinance it, or pay it down. And refinancing is not a technical detail, it's a confidence game. When confidence is strong, refinancing is routine. When confidence breaks, refinancing becomes expensive or impossible. 6. What the top 5 claim really teaches. In the debate, you'll hear lines like, Egypt is among the highest in the world by external debt relative to exports. The precise ranking can vary depending on the metric used, but the deeper point is correct. Exports are the oxygen line, and the cost of debt relative to exports can become extreme. In fact, a World Bank debt report flagged Egypt among the countries with the highest interest payments on external debt relative to export earnings in 2024. Now, notice what that means. It does not automatically mean default tomorrow. It means the margin for error is thin. When your interest burden is high relative to exports, you are more exposed to export shocks, shipping disruptions, tourism drops, commodity price swings, and investor risk-off cycles. That's risk thinking, not panic thinking. 7. Selling assets to pay debt. What it is and what it isn't. Now to the controversial line. If we sell assets to pay debt, is that investment? Economically, selling assets can do 3 very different things. 1. Emergency liquidity. You sell to pay what's due because you lack cash. 2. Balance sheet repair. You sell non-core assets to reduce risk and stabilize financing. 3. Productive privatization. You sell in a way that improves efficiency, attracts long-term investment, and expands FX earnings. The problem is, these 3 look similar in headlines, but they are not the same in outcomes. Here's the clean test. If asset sales are mostly one-off cash injections, they buy time. If they also improve productive capacity and FX earnings, they can change the trajectory. So, asset sales are not automatically good or bad. They are a tool. The question is whether the tool is being used to bridge toward a stronger system or to delay the same crisis by a few months. 8. The human layer. Did life improve? The commentator's strongest argument is not technical, it's moral and social. If we borrowed in the name of development, why does daily life feel harder for so many people? That's not an economic equation, but it is an important measurement. A government can build infrastructure, reduce a currency crisis, and still fail the daily life test. If growth does not translate into jobs, real income stability, and basic services. Economists often miss this because we love aggregate indicators. But systems legitimacy is built in the micro layer. Households, wages, prices, school quality, healthcare access, and whether opportunity feels real. This is where the debate becomes emotionally charged, because it's about lived reality. We can acknowledge that without turning it into a tribal war. 9. Counterexample. When high debt is not automatically fatal. To think cleanly, we need a counterexample. There are countries that carry high debt and survive, sometimes even thrive, because their exports are strong and diversified. Their interest costs are low, concessional or long maturity. and institutions are predictable enough to refinance calmly. In that world, debt can be a bridge. Borrow, invest productively, export more, repay. So the real enemy is not debt. The enemy is debt without a reliable return path, especially in foreign currency. And this is why the export lens matters so much. If exports are structurally constrained, debt becomes a treadmill. 10. Practical heuristics. How to think without propaganda. Now we compress everything into 3 rules. Heuristic 1. Don't argue about the number, argue about the ratios. A debt headline is a photo, ratios are the movie. If someone says, debt is X dollars, your follow-up is, debt to exports, interest to exports, residual maturity, because that tells you whether the system is breathing or choking. Heuristic 2. One-off money is not a plan. If stability depends on rollovers, exceptional deals, or asset sales every year, you don't have a growth model. You have a survival cycle. A plan is repeatable, a rescue is not. Heuristic 3. Bound the risk. Don't chase certainty. In the real world, nobody knows the future perfectly, so we don't chase perfect forecasts. We ask, what policy choices bound the downside? Reduce exposure to refinancing shocks, improve FX earnings capacity, and prioritize projects with measurable returns. Because the system doesn't need perfection, it needs resilience. 11. Closing. Transparency is a stabilizer. The most constructive demand in the entire debate is not anger, it's transparency. If the state can explain, project by project, what was financed, what it returned, and how it supports future FX earnings, it reduces rumor, fear, and risk premiums. Transparency is not a luxury, it's a stabilizer. So the question, where did the debt go, can become a productive national conversation if it's answered with clear accounting, measurable outcomes, and a credible path from borrowing to earning. And for us, as learners, the takeaway is even simpler. Whenever you hear a debt debate, don't get trapped in slogans. Build the model, measure arrow, compare arrow, stress test arrow, correct. Because in economics, just like in navigation, the most dangerous place to be is confidently wrong.